Hi, I'm Lango, and this is Investor Place Quick Picks, where we communicate to you some of the market's best investment ideas in just 5 minutes. Today, we're going to be talking about a streaming TV stock with enormous long-term upside potential. The name Roku, ticker ROKU. Now, Roku stock has been absolutely on fire ever since its September 2017 IPO. Since the stock came public, it has rallied quite literally 2,000%. It's an enormous rally. It's easy to look at that rally and say, yes, Roku is a long-term winner, but the stock is fully priced. Even Wall Street, who typically acts more like cheerleaders than analysts sometimes for growth stocks like this, even Wall Street analysts have a sell-side price target that is below the current Roku stock price. So, from many different angles, the Roku stock is overvalued thesis seems to make a lot of sense. But it doesn't make sense from the most important angle. And the most important angle is the long-term growth prospects of the company. You see, Roku is a $36 billion company that is fundamentally and actively disrupting the $160 billion global TV ad industry. As a $36 billion company disrupting a $160 billion industry, the stock is not overvalued. Instead, Roku is a $100+ billion company in the making, and Roku stock has visibility to $1,000 prices within the foreseeable future. Here's how we get there. So the first big component of the Roku stock bull thesis is that streaming TV is going to take over all of entertainment. Okay, so I like to think of the streaming TV revolution as a game with two halves. The first half played out in the 2010s, where we all adopted Netflix and Hulu and Amazon Prime and Disney Plus and HBO Max, and it was great, right? Because those services gave us the best movies and TV shows on the planet. They replaced movie theaters. But what they didn't replace was linear TV, because they didn't have live TV. They didn't have live sports. They didn't have news channels. And so today, the most common mix in America is for families to have a Netflix subscription, a Hulu, Amazon Prime, maybe Disney Plus subscription, and then a linear TV package, i.e. linear TV is still a part of the entertainment mix today. But that won't be the case forever. Because right now, a new class of streaming TV services are emerging. YouTube TV, Sling, Fubo TV, wherein they are finally offering live TV, live sports, news channels, everything you get in a linear TV package just put into a streaming TV service. And because streaming is so superior to linear, and the pricing's better, it's far more convenient, the connectivity is enhanced, you can have multiple screen optionality, it's just way, way better. You get rid of all the cords. Well, now that the content firepower is matched, guess what? We're all gonna cut the cord. So over the next decade, the entertainment mix of households is going to shift from Netflix, Amazon Prime, and maybe a linear TV package to Netflix, Amazon Prime, and a streaming TV package. Essentially meaning that we're gonna go from a mix of linear and streaming today to all streaming tomorrow. Now, ad dollars follow eyeballs. So as all the eyeballs leave the linear channel and go into exclusively the streaming channel and the linear channel dies, ad dollars will follow suit. That's a big deal because there are $160 billion spent every year on TV advertising. Most of those ad dollars are still stuck in the linear channel. They're going to shift. This is $150 billion shift happening right now. And guess who's at the epicenter? Roku. Now, Roku is creating the cable box of streaming TV. In essence, Roku is a marketplace that connects streaming subscribers to streaming services and streaming services to streaming subscribers. right? If you're a streaming service, then you're going to launch your service on Roku because they have huge distribution and you want those eyeballs, you want that exposure. If you're a potential streaming subscriber, you're going to use Roku to access streaming services because chances are that the streaming service is accessible through Roku. Roku has partnerships with all the streaming service channels out there. Now, as a marketplace, Roku will benefit from marketplace effects. So what are marketplace effects? Well, essentially, the more consumers that Roku gets, the more attractive the platform is to streaming services because it means more distribution. So the more consumers they get, the more streaming services they get. Now, the more streaming services they get, the more attractive the platform is to consumers because it means there are more options, more accessibility on the platform. So more consumers lead to more streaming services, which lead to more consumers, which lead to more streaming services. Lather, rinse, repeat. It's a positive growth flywheel, which ensures that Roku, as the market leader today, will sustain market leadership as the streaming TV market goes from niche to globally ubiquitous over the next several years. And that's an exceptionally valuable position to hold, the cable box of this burgeoning industry, because it puts the company at the epicenter of this $160 billion ad shift. So what's the math for Roku stock to get to $1,000? Well, the back of the envelope math is not too hard to understand. Okay, globally, there are about 450 million streaming TV households today. Roku will finish 2020 with about 50 million active accounts. That gives the company roughly 10% global user market share. If you assume 1-for-1 from user market share to ad market share, then Roku should control about 10% of streaming TV ad market share at scale. The $160 billion TV ad pie, yeah, all of that is gonna go to streaming TV because the linear TV channel is gonna be extinct by 2030. It's not even gonna exist anymore. So all the ad dollars that are in linear TV, all of them are gonna shift into streaming TV. So a 10% share on $160 billion would give Roku about $16 billion in revenue, assuming roughly 35% operating margins, which is pretty standard for a digital advertiser, and a 20% tax rate, the nationwide corporate tax rate, then you're looking at, according to my numbers, around $30 to $33, $35 in earnings per share for Roku by, I'm thinking 2029, 2030, in that range. You put a 25x multiple on that, and that's how you get to a stock price for Roku above $800. Importantly, that assumes only 10% market share, when in fact, Roku's market share will probably be bigger than that because the company is growing much more quickly than the global streaming TV space. And 2, it includes zero upside from the hardware business. Remember, Roku sells TVs, they sell streaming device makers. That is a business that generates money that will add value here. So when you add those things into the cake, when you bake them in, all of a sudden it looks like Roku stock has clear visibility to at least $1,000, if not higher. And for that reason, and that reason alone, I think Roku stock is a great long-term buy and hold situation. Well, that's all we have for this edition of Investor Play's Quick Fix. I hope you like what you saw. If you did, please subscribe, hit that notification bell, smash that like button, follow me on Twitter, and if you like to read, come over and visit us at investorplace.com, where we have some of the market's best analysis. Until next time, cheers and happy investing to all.